we are going to take a look at a case study here. This is an individual who recently acquired a policy with our company, and it was designed for maximum cash value, all that good stuff. But he had a couple questions around how to best fund a policy while taking loans out as well, and had a couple really good questions around the best way to repay loans and if he should even repay the loan or if he should direct his money constantly toward premium and PUA payments. So let's get into it. What we've got to lay the specs out is a policy on a 36-year-old male. He wanted to fund the policy initially with about 150 grand. He had 150K in savings, money he had access to, but wanted to get it into a policy over 3 years. So this is where you're going to see the first 3 years of the policy, 50K per year going in. From that point forward, up until age 60, he has $20,000 of cash flow to work with that he wants to dedicate to funding the life insurance policy. Now, he'll always have the ability to go up to 50K, but the dedicated cash flow is 20K per year. Now, this is going to be important when we start to look at the loan payment options, because what he wants to see is a loan coming out in policy year 3. And then his question was, hey, what's the best use of my $20,000? Because if I'm funding a policy with 20K per year, I don't want to be locked in to paying that and have to pay more money on top of that in loans. Meaning I don't want to have to pay 20K in premiums and PUAs, and then in addition to that, throw money into loan repayments. No, 20K is my cash flow. That's where he started. The 20K, what's the best use of that? That's my number, Steve. So we're going to stick with the number of 20K and look at different options. Does it make sense to pay the loan down aggressively first? Do I ignore the loan balance and just keep feeding the policy with premium and PUA payments? Or do I do a combination of both? Do I pay some of that $20,000 into the policy and then the other portion of the 20K attack the loan balance with? Well, let's take a look. So first thing is first, let's look at the policy optimized for growth, which this is going to look very consistent with most policies we design. So there's the 50K for the first 3 years. This is a policy with a 10/90 split. So 10% premium, that'd be 5K. He does have a term rider attached on there as well, but the majority of the 45K is going toward PUAs, accelerating cash value growth for that total of 50K per year. Okay, so we've got the cumulative payments, break-even point between 3 and 4. So he has access to that capital. This way he can take advantage of the loan provision earlier rather than later. Now this does not give up long-term performance either, which is nice. So why we always like to look at the growth scenario first is anytime I look at any loan options, any loan simulations, is what does my policy look like compared to the growth model? Meaning if I just pay money in there, let it sit and grow, I know how it's going to perform or get an idea on how it's going to perform, but how does taking a loan actually impact it? And then if I pay it back, pay interest only. That's the kind of stuff we like to compare. So we've got more knowledge in advance or more knowledge prior to actually executing that transaction. All right, so on the left, on the left, we've got the growth model. 50K for the first 3 years, then 20K all the way through age 60. And one thing I did not touch on the last sheet is the total payments into that policy, funding 20K per year up until age 60, is 590 grand. That is his total input, and then the cash value's a little over $1 million in this example. Now, with that said, the number you want to keep in mind for all of these scenarios is $490,000. The reason why, that's my net out of pocket, considering the fact that I pay in that same schedule, 50 for the first 3 years, and then 20 per year up until age 60, but then also take out this loan of $100,000. So we back the loan out. So I paid in 590, but when I pull out that 100K, now my total net out of pocket is technically $490,000. And it will stay there because as we continue to look at models where he pays in $20K per year, the max he pays in per year up until age 60 is $20K. At no point in time are we going to assume that he pays in more money on top of the $20,000. If he can do that, that'd be great. But again, $20K is the number, so let's stick with the $20K. So first, let's examine the loan quick here. In case you haven't seen examples of how policy loans work, I take the $100K. My cash value is my equity. That determines how much money I can access. In the example where I let it sit and grow, it was $146,000. When I pulled out the 100, now it's $41,000. So where is the extra $5,000 or $6,000 there? Because I only pulled out 100. Why did it drop down to 41? The reason why, and we did this in all of the examples, well, this one is easy to demonstrate. There's no payments at all. So we have $6,000 of loan interest. The loan interest rate is 6% in this example. The policy will borrow from itself. It's going to borrow from the cash value to cover that loan interest. That will happen if I do not pay the loan balance or the loan interest on a life insurance policy. So that's why my cash value drops by more than the 100K. And that's also why I see my loan balance at 106 in policy year 3. Now, the beauty to a life insurance policy is I'm still going to earn dividends on any money in cash value and any money outstanding in loans. How and why the company does that is, one, I have loan interest, but two, look at your death benefit here. You're going to see this on every example. So the loan balance is 106. What is $2 million minus $106,000? That exact number. Anytime we borrow from a life insurance policy, the company still pays us dividends and interest on everything, but they do collateralize our death benefit dollar for dollar. So if we die with a loan outstanding, they're going to pay the death benefit out minus the loan balance. Okay. Now, let's take a look here. Why don't we focus on the end of the funding period, the age 60 value, age 60 cash value. So he borrowed the 100K and then just ignored the loan. So here's the loan interest accruing. Then by age 60, in dark red, loan balance is just about $382K. His cumulative payments, $490,000. So he paid in $590, but then he pulled out $100. That's why we've got the $490 there. Cash value, $663,000. Death benefit, just about $2 million. So I paid in $490, I've got $663. This is the example where I pulled out a loan and then just ignored it and said, hey, I'm going to keep paying my 20 grand per year in premiums and PUA payments. Because the thought here is, hey, if I pull out a loan, I'm still earning interest on that, right? So would it make more sense to ignore the loan and continue to make premium and PUA payments? Before I answer that, let's look at the spreadsheet so we can actually see it. Did you ever hear the saying? I love this saying. People tend to trust what they see, not always what they hear. That's why we always show spreadsheets. Seriously. So on the left, same scenario with the growth. Paying money in, let it sit and grow. And then this one was fun to put together, the illustration software. So we paid in the $20,000 per year. I'm sorry, the $50,000 for 3 years, and then reallocated the $20,000 towards the loan repayment, and then redirected it toward premium and PUA payment. So what we did here, you see $50,000 for the first 3 years, that $100K loan, the exact same relationship with cash value death benefit occurred in year 3. But what we did then, look at years 4 through 9. Money that we are allocating toward premium and PUA payments is zero. Zippo. What we're doing with our $20,000 instead is directing it toward the loan payment. So here we are going to aggressively pay it down. And then when year 10 came, there was about just about $2,500 left in the loan balance to pay off. So we paid that off and then put the difference, the excess here, the 17.5, back towards premium and PUA payments. That way our net remained at 20K. Remember, Steve, my cash flow is 20K. I do not want to see more money going into the policy on top of it. It's good to look at this kind of stuff. If I have more money to add on top of it, well, that just accelerates everything and it looks better then. But it's good to look at these consistent cash flow scenarios. So what we are going to see here, actually, I forgot one important thing. Loans paid back, year 10. Cash value, $203,000. Net out of pocket technically has been $190 at that point in time. Okay. Cash value, 752, almost 753,000. I paid the loan off first, so I don't have any loan interest dragging on the policy. After that loan was repaid, what did I start to do? Redirect my money into the policy via premium and PUA payments. So what happened here? 752, almost 753. Do you remember what the value was in the last example? Go back here. Our last sheet is going to put them all side by side. $663. Same out of pocket. We're just addressing the loan differently compared to $752. That's a substantial difference. And this is the same exact insurance company, product design. Everything's identical. We've got the growth scenarios on the left here. So in this case, it makes sense to aggressively pay the loan off first. We're going to look at one more scenario here. Scenario 3 is same policy via the growth sample, but then same policy funding, 50K for 3 years, 100K loan. Everything's the same regarding the collateralized death benefit, all that good stuff. But this one was fun. You'll want to look in bold blue here, where it reads total out of pocket. The reason why is when we took that 100K loan out, what we solved for here was, again, no payments in year 3, because you wanted to start payments after year 3, beginning year 4. So we deferred it. Loan balance grew to 106, and then started paying it back at 8305 per year. Where we came up with that oddball number is I wanted the loan to be paid off by age 60 at the end of the desired funding period. So what we did here, and we can always mix and match this, doesn't have to be that oddball number, that's just my OCD. Here's our premium and PUA payments here. The difference, $11,695. So why I mentioned, look at the total out-of-pocket column in bold blue, is if I'm paying almost $11,700 in payments and $8,300 in loan interest, that totals the same 20K per year after the first 3 with 50 grand per year. Okay, so a lot of stuff going on. Let's look at the most important piece. Does it give me more or less money at the end of the day? That's what I'm interested in. Because here I continued to feed money into premiums and PUAs every single year, which in theory should continue to yield compound interest for me. Year 20, $734,000. So close, but no cigar. The last example still produced the most cash value. So here we have a nice side-by-side comparison. First, we've got the growth sample. This example assumes no loans, just paying money in, letting it sit and grow. That guy's obviously going to have the most cash value. Then we've got the other scenarios where we pulled out that 100,000, kept our cash flow identical, and attacked the loan. You know, if we took a loan out in the growth sample and then paid more money back on top of the loan, then we'd see the cash value fully restored. Here, we are not doing that. So, who's the winner? we've got it highlighted in yellow, but let's look at the end of the funding period. The example, when I never pay the loan back. Instead, I just continue to direct my cash flow toward premium and PUA payments. The cash value must then borrow the loan interest to cover it each year. This example, aggressively paying it off initially. So years, 4 through 9, my premium and PUA payments were 0 because I directed all of my $20,000 toward the loan payment. And then the example when I partially paid it back, 734. This is much closer. However, because I chipped away at the loan interest first, there's your winner. Paying the loan off first. Does this mean it will always make sense to pay the loan off first? That's always the number one answer? No, not in any case. This is something we do like to look at in every specific scenario because my intent might be to sell a piece of property and pay a loan off in a lump sum 5 years down the road, and I'm going to fund the policy in the meantime. Whatever my scenario is, it's always going to be a case-by-case basis to some extent. This is one case study which the numbers came out interestingly enough to say, hey, instead of continuously funding the policy, put the funding on hold, kick that loan interest down in the loan balance, and then redirect money into the policy, and you walk away with more money. Which our goal is what? Maximize cash value and see how we can best utilize the money. So hope that you enjoyed this case study. More to come in the future, and we will talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.